Hello, and welcome to the 200th episode of Jeff's World, the weekly show where our goal is to help you make more informed investment decisions. This will be the last Jeff's World as I head into retirement. On today's show, we're going to cover key opportunities and risks for investors tied to developments around the world. We've got a lot of them to cover. It's our mid-year outlook. We're going to preview all of that. And of course, we're going to take your live questions from the chat on YouTube. So you can ask us what's in your mind at any time by entering it in the chat. And we'll get to those questions in a few minutes after we share some of our latest insights. We love reading the chat, so thanks for participating in that every week. We always love to dive into all that. Now, we've got a few required disclosures, of course, before we get started. We don't know you personally, so we don't make personalized recommendations, but we do talk generally about the markets and sectors and areas of investing we think are likely to perform well or poorly and why. And things can and do change, so all the thoughts we share are subject to change as well. And of course, investing has risks, and international investing has unique risks like currency moves. So please keep all that in mind. Now, as usual, I'm joined by Michelle Ghibley and Heather O'Leary on the global strategy team at Charles Schwab. Good morning, ladies.
Good morning, Jeff. Good morning, everybody.
Good morning, everybody. As stated, I will be watching the chat and looking at your questions closely, and we will get to those. Jeff, can you go ahead and kick us off one last time with a quick rundown of what we're watching this week that could move the markets?
Yeah, so here's what's going on this week. So today, the U.S. Senate returns from a break. You've got the Republicans trying to work out a Senate version of the House-passed tax and spending package. And of course, that comes after a U.S. trade court last week blocked the Trump administration's use of the International Emergency Economic Powers Act for tariffs, but then a stay was granted as it goes through the appeals process. That keeps tariffs in place while the legal battle continues. If the Trump administration loses the appeals, it still has other means to increase tariffs, but there may be less urgency for countries to cut trade deals now. The U.S. Treasury Secretary has said talks with China have stalled. Much more on that in a bit. So tariffs are going to remain on the headlines here this week. On Tuesday, tomorrow, we're going to get China's manufacturing PMI. That's the Caixin PMI, the private sector tracked PMI, which is what we watch really closely. It's expected to show a recovery in activity due to temporary tariff reductions and resumed U.S. orders. Data show a pickup in U.S.-bound shipments from China in the first half of May after April's very abrupt slump. So we'll see how that shapes up for manufacturing in China. On Wednesday, we're going to get the Bank of Canada's decision on interest rates. The central bank paused its series of rate cuts back in April. In the past 8 cycles over the last 25 years, when the Bank of Canada paused, it typically stayed on the sidelines for multiple meetings. Given the heightened uncertainty around U.S. tariffs, it seems likely the central bank will remain on pause back-to-back this week. We'll see if they're due for another cut later this week. So there'll be a lot read into what the comments are around that announcement. And on Thursday, however, the European Central Bank is likely to cut rates by 25 basis points for the 8th consecutive meeting. They're not going to skip. That's probably going to bring, very likely they're not going to skip. That'll bring the rate down to 2%. In Europe. 2% is the inflation target, of course. It's also where most of the forward inflation forecasts are for Europe. It's the middle point of its neutral rate estimate. It's the market's long-term inflation forecast reflected in the 5-year forward inflation swap. And it's also basically right where inflation is right now. It's if we take a look at the PMI and take a look at what it's pointing to over the next 6 months, also right around 2%. I just posted that on my X and LinkedIn feeds this morning, the chart that shows that crystal ball for predicting inflation. It's right there, but I still think we're probably going to see another cut. I don't think that means the ECB stops cutting here at 2%. They could go a little bit below 2% given maybe the downside risk to inflation from there, the downside risk to economic growth given the tariffs. So I'd expect at least one more cut this year after this week. Now on Friday, that was Thursday. On Friday, we're going to get the U.S. jobs report for May, and that's expected by economists to show a slower gain of jobs, about 130,000 jobs in this country. That will be below April's total. And one reason for that softer reading is leisure and hospitality. We're seeing subpar international tourism. Europe travel to the U.S. is down a bit. Part of that is the, just tariffs and issues, but U.S. Travel is just generally travel to the U.S. has just slumped a little bit here. International tourism is a bit weak, and you've also seen a pullback in government travel led to, tied to DOGE and other factors as well. All that's led to a little bit of a slump in demand. Now, this is the time of year, as I previewed, when we unveil our mid-year outlook. That publishes later today on Schwab.com. It's like 2,500 words. It's big, it's beefy, it goes into a lot of details. I encourage you to check it out. But I think it makes sense for us to give you a preview of what that looks like. In short, global markets have largely recouped the losses made in the wake of that April 2nd tariff announcement. Resolution to tariff uncertainty will take time, but it appears investors are becoming conditioned to extreme tariff threats as negotiating tactics and maybe taking a longer-term outlook. Uncertain U.S. policy and lagging U.S. stock market performance has prompted investors to look overseas for opportunities, as we've been pounding the table this year. The first half of 2025 is a case study on why investors should consider international diversification as a way to manage market volatility. The second half of the year may see volatility and the international stock market leadership we'd forecast in our 2025 market outlook published back in December. That could remain a trend. Now, Michelle, I previewed what's going on with tariffs, but maybe, I think it's sort of interesting where they're going right now. There's been talk about taco, Trump always chickens out. I'm not sure that's the case, but would you say that tariffs might be losing their bark?
Yeah, I think it's possible. I mean, if we look at the market action today, S&P 500 is down, 0.2% on some new tariff threats just over the weekend. Trump increasing steel and aluminum tariffs to 50% and some ratcheting up of tensions between China and the US, and the market's not really doing a whole lot. So I think, investors and businesses and consumers, they've really had to weigh, these tariffs being implemented and paused, de-escalated, court challenged. It looks like the worst case scenarios that were proposed in early April may be off the table, but I think we're going to have this trade uncertainty remaining. There's been some progress, but I think there's still a lot more work ahead than has been settled. As you mentioned earlier, the U.S. Trade Court blocked the use of emergency powers, the IEEPA tariffs, but a stay was granted as it goes through appeals, and that keeps tariffs in place while this legal battle continues. And if Trump, the administration loses the appeals and is unable to use IEEPA, they still have other means to increase tariffs. They could use the Section 122 of the Trade Act of 1974. That allows a 15%, 15 across the board tariff for up to 150 days. Or they could use Section 338 of the Tariff Act of 1930. That allows for up to a 50% rate, 50, with no limit on duration. Additionally, sector-specific tariffs like we have on aluminum and autos and others, those could continue. The Section 301 tariffs were used during the previous Trump administration for use on Chinese imports. Those could be accelerated and broadened. Overall, though, I think, as we get closer here to the second half, trade negotiations could become more difficult. There could be less urgency for countries to cut deals, particularly for those with lower sector-specific exposure, given all of this back and forth. I think it doesn't really make a lot of sense for countries to come to the table right now without really knowing what the future looks like. And for markets, I think there's some relief that the tariffs could be reduced in severity, duration. But I think there's, the next steps are quite complicated. And the uncertainty is likely to continue for businesses and for the economic outlook. And we've talked about it before, but U.S. trade deals typically take 18 months on average for both parties to sign an agreement. Investors, though, they're adapting. Markets are now higher than they were on April 2nd. We have trade deals with the UK and China, and those were seen as progress, even if they were thin on substance. 2 weeks ago, the President Trump's, or maybe it was a week and a half ago, President Trump threat of 50% on EU imports resulted in European stocks recovering half of its losses by the end of that day. And then last week, the S&P 500 was little changed, despite the back and forth of first receiving the news that the court ruled to block the new tariffs, and then after the stay was granted that same day. So it seems as though investors are becoming a little desensitized to tariff news. And so the economy is yet to feel the bite of tariffs, but their economic bark may be already reducing, fading. So we're going to get market volatility related to tariffs potentially return. We saw during the first Trump trade war with China in 2018-19, tariff rates increased after a 90-day reprieve. So tariff rates could increase again. But there are signs that the Trump administration wants to make deals. So reportedly, there's going to be a call between President Xi and President Trump later today. But, as the year progresses and markets look, toward the future of potential resolution, these market reactions may become smaller. We're already seeing it. But what do we see in terms of the economic outlook, Jeff?
Yeah, so it's interesting. Yeah, the market has clearly become increasingly desensitized. The size of the moves have become smaller and smaller and smaller in these announcements. And I know, Heather has done a great tracking, looking back, looking at, during the first Trump administration. I mean, you did this a long time ago, Heather, but just looking at every day when these new kind of headlines came out, a new tweet or something, and the market didn't, increasingly reacted kind of less and less. We're seeing echoes of that now. But what about, so that's the bark of tariffs, right? But what about the bite of tariffs? Like, how much of a bite are they taking out of the economy if the bark in terms of the commentary and the markets doesn't seem to be taking much of a bite anymore? Well, the Bloomberg consensus of economists did lower their estimates of global growth this year, in part due to the trade war. Currently, the highest tariffs apply to imports from China into the U.S. and imports from the U.S. into China. And as a result, those two countries are likely to experience the largest negative economic impacts. They're the 1 and 2 largest economies in the world. But there are some positive news here. Despite the reduction in the growth outlook for 2025 for those two economies, neither the global economy nor China or the U.S. are expected to be in a recession. That, is really interesting. If you look at this chart here, I use this chart a lot, publish it usually in our outlooks every 6 months. What it does is it takes a look at what the forecast is by the OECD here, but that's the Organization for Economic Cooperation and Development. A lot of PhDs doing a lot of forecasts for the largest 45 economies in the world. That's what you're seeing on the left scale there. But this echoes what we see from the IMF, from the consensus of economists tracked on Bloomberg, from private sector, public sector economists. So you're looking at 45 economies here. How many of them in recession? That's red. How many of them are growing is green. Dark green means growing and accelerating. Light green means growing, but a little slower than last year. And what you see here is the forecast for 2025, growth. Not one of the world's largest 45 economies is expected to see a recession in 2025 by the OECD, which is pretty remarkable, given the potential threat of the pullback in trade that could come along with this. So, most economists are forecasting a relatively mild hit. And by the way, this is true for 2026 as well. Generally, what we're seeing here is most economies are actually expected to grow and accelerate in 2025. So a lot of smaller countries out there, we know China and the US are going to be slowing down, but there are many smaller economies expected to see an acceleration in growth this year. And I think that's worth noting, worth calling out. So diving into some of the more details around the economic outlook, despite the trade war, Eurozone data has come in better than forecast. The Eurozone's been our favorite region this year. If you look at the Citigroup Eurozone Economic Surprise Index, this index measures how data is coming in relative to expectations. If it's positive, that means data is beating expectations. If it's negative, it's missing. So not only have expectations gone up, but the data is beating those expectations. And if you look at leading economic indicators, there's support for continued expansion in Europe. If you look at the OECD's leading economic indicator for the 4 largest economies in Europe, Germany, France, the UK, and Italy, they posted a record 30 months in a row of consecutive increases in April. So really a lot of building strength. We've never seen this type of momentum in Europe. And this is after years of austerity. So things are really turning around. Monetary policy stimulus, fiscal policy stimulus, really improving. One of the reasons why European stocks are up like 26% this year. But that contrasts with the US leading economic indicator from the Conference Board, which fell for the 5th straight month in April. So very different outlook, what you're seeing in Europe versus in the US. One of the reasons why I continue to be bullish on Europe, despite the 20+% outperformance we've seen so far this year. And Michelle, one of the reasons for better growth is that we're seeing a pickup in fiscal stimulus in Europe.
Yeah, that's right. We've been talking about this on this show. We've talked also a lot about monetary policy stimulus in recent years, but that may fade as we get into the second half of 2025 because inflation is at a spot where central banks may pause. As you talked about earlier, higher tariffs in the U.S., those could raise consumer prices and boost U.S. inflation. But over the longer term, the potential for slower growth could be deflationary. Now, outside of the U.S., inflation could move lower, particularly if other countries don't retaliate by increasing tariffs on U.S. imports. Then that's due to potentially slower U.S. growth, and also because their currencies are rising, and that can reduce import prices and inflation. Now, we're still expecting rate cuts for most major non-U.S. central banks in the second half, but the pace could slow, and Japan, of course, is an exception. They're still raising rates. A hike by the Bank of Japan is still possible in the second half. But fiscal policy is gaining momentum. Canada has planned a fiscal stimulus in the form of tax cuts and spending growth. Australia has touted tax cuts and support for households for energy costs. Japan has approved a spending package to support businesses and households adversely affected by the U.S. tariffs. And of course, Germany is the one we've talked about the most. They're shifting away from austerity with a very sizable stimulus that could lead other European countries to follow. They're talking about a combination of additional defense and infrastructure spending of €1 trillion, and that could add 1.5 percentage points to Germany's economic growth every year for the next 10 years, and really be a new growth story, this time in Europe. And now the potential for the U.S. to back away from military guarantees for other countries is also prompting NATO as a whole to more than double its spending. NATO is considering a commitment to 5% of GDP to be spent on defense by 2032 at their June 24th, 25th meeting. Now that would be 3.5% allocated to core defense and another 1.5% on cybersecurity and defense-related infrastructure. Now the risk is that the so-called bond vigilantes, those are investors who demand higher yields as compensation for excessive government spending. And we've seen signs of this in terms of yield spikes on longer-term government bonds in both the US and Japan recently. Now, rising government debt yields results in fiscal spending becoming more expensive due to increased debt service costs. It can also hurt the balance sheets of institutional holders of long duration bonds. This would include banks, pension plans, or life insurers. It could slow economic growth, and it could cause policymakers to reduce spending. Now, at this time, increased government yields in Europe have not spilled over into currency weakness or market losses, stock market losses, perhaps because the fiscal spending is viewed as a positive for economic activity. What do you think, Jeff?
Yeah, that's a really important distinction there, right? So in the US, rates have been spiking up and the dollar was falling. And that's just a sign that investors were shedding US assets and getting out of treasuries. That's not the case in Europe or Japan, where we're seeing yields go up and actually money's attracted into those markets. Generally, when you see a problem around fiscal policy, you think back to the Liz Truss moment in the UK a few years ago, where they put out that mini budget, and it kind of blew the market's mind. The bond market sold off, yields went up, and the pound really took a dive. So when the market's rejecting fiscal policy that a government is putting in place, you generally see, sometimes yields go up, but the currency usually falls pretty sharply. That's not happening in Europe. That's not happening in Japan. So even though rates are rising, it's not really a sign of fiscal pressure or that bond vigilantes are selling off and moving their money elsewhere. actually moving their money into those markets. It's really just some pressure here in the U.S. for a variety of different reasons that we're seeing both yields having gone up and the currency gone down. Very unique scenario. And part of it, yeah, is that one of the reasons why Europe's budget is increasing, it needs to issue more debt, is because it's going to be spending a lot more on defense and infrastructure, which actually have pretty good multipliers for economic activity. You know, a dollar spent in infrastructure is usually like at least 80 cents into the economy, if not a dollar or more. So GDP grows just as fast as debt does. So the debt to GDP ratio doesn't change. And that's a positive for Europe, maybe Japan as well, as we look at this situation. And that's why it's different. Yes, you worry a little bit when, you know, debt's rising and interest costs are going up. But in this case, I think it's probably manageable. And that's where those economies still look attractive to us. And look, the economic side, we spent a lot of time on it, but it's really the earnings side that matters the most, right? When you buy stocks that are headquartered in a certain country, you're not buying shares in the country, you're buying shares in that company. And so what's the earnings picture look like? Earnings drive long-term market performance. And the first quarter earnings season in Europe was the best in years. 59% of companies in the Europe Stock 600 index beat estimates. Now you might get used to hearing, ooh, 75 or 80% of US companies beat estimates. That's because we play a game in the US where companies kind of lower their estimates going into the earnings season and then beat them. They don't do that in Europe. They don't really manage quarter to quarter. Many companies don't even report on a quarterly basis. So you tend to see companies, you know, not so often beating estimates. In fact, I think usually like 54% of companies beat estimates in Europe. And it was 59% this quarter. That's the best quarter we've seen in years. 4 percentage points more than usual, and a pretty good earnings season. And if you contrast that with the US, you got the number of companies in the S&P 500 index with downward earnings revisions to future quarters. It's come back down, but it recently spiked up to a level that we saw during the Great Financial Crisis, during the COVID pandemic. But for non-US companies, it spiked a little, but it got nowhere near out of its normal range, and it was nowhere near past crisis peak. If you look at this chart, so this is the number of companies in the S&P 500, the blue line, that saw downward revisions to earnings during the first quarter earnings season. You can see that big spike up in the blue line. We've only seen higher spikes during the pandemic and during the global financial crisis. But the orange line is Europe. It spiked up. And it's coming back down, but it didn't really get out of those range, got nowhere near what we saw during the GFC or the pandemic. So very different picture here in terms of what the forward-looking environment is like for earnings in Europe and international overall versus the US. In fact, I just point out here, in aggregate, earnings estimates have continued to rise for the EFI index. EFI isn't just Europe, it's all of international. It's Europe, Australasia, and the Far East is how they named the index back in 1969. Really weird, but it's all the developed markets in that index, and it's still rising. US earnings revisions have rolled over, estimates have started to fall. Not true outside the US. And that healthier economic and earnings cycle outside the US certainly likely contributed to the EFI index outperformance so far relative to the S&P 500 by a very wide margin this year, something we haven't seen in quite a long time. But building on this sort of almost 3 years, 2.5 years of outperformance by international stocks here, really supported by this brighter earnings outlook. You know, and I guess the dollar's contributed to this as well, right, Michelle?
Yeah, that's right. The weaker dollar is also adding to the outperformance. You know, we had more than a decade of dollar strength. Yeah. People are overweight in U.S. assets and many global portfolios. And of course, we've had a little bit of unpredictable U.S. policy this year. So investors are gradually adding to non-U.S. assets, and that's contributing to strength in non-U.S. dollar currencies. Now, the potential for a rising fiscal burden in the U.S. is also weighing on the dollar. Now, if tariffs end up reducing the U.S. trade deficit, that would likely result in fewer dollars held abroad that would need to be recycled into dollar assets, and that could also add pressure on the value of the dollar. Now, we believe that the dollar is likely to gradually decline due to the fallout of these U.S. policies and as investors allocate to non-U.S. markets. but it doesn't mean that it's a crisis. The dollar has often cycled between strength and weakness for multi-year periods in the past. Now, the mirror of a decline in the dollar is a stronger foreign currency. So, for example, a stronger euro relative to the US dollar means that earnings denominated in euros exchange into more dollars, which boosts returns for US investors. Jeff, do you have any other thoughts on the market performance?
Yeah, well, sure. I mean, look, we've probably seen, so we know, so I'm just looking at my screen, my Bloomberg screen. So the euro is up 10.46% against the dollar this year. The Japanese yen is up 10.2%. So when we talk about 25% outperformance by stocks in Europe versus the US, almost half is the currency. And for Japan, it's most of it. So the currency matters here, and it's been a headwind for so long. The dollar had been rising for a variety of reasons, and that's really turned around. Relative economic momentum, relative interest rates, money flows, all these kind of factors are kicking in here, and they generally are. The dollar tends to move in these multi-year, almost decade-long cycles. I think we made a peak, and we started to see this dollar begin to decline. And so, does it continue to decline at 10% every 6 months? No, but certainly probably likely to continue to see at least modest dollar decline over the coming years, further adding to the fundamental outperformance, both economically and from an earnings perspective, helping to boost stocks. The outperformance of U.S. stocks for most of the past 15 years in terms like U.S. exceptionalism resulted in many investors giving little consideration to international exposure in their portfolios for a long time. The weight of the MSCI EAFE countries, developed non-U.S. countries, in the all-country world index, meaning the index of all the stocks in the world, has been cut in half. It was around 40% back at the end of 2009, the last long period where we saw international stock market outperformance from 2001 to 2009. And then when the U.S. outperformance began back then in 2009 to November of 2024, it dropped to 20%, really cut in half. And really amazing. And that shift also likely occurred in many investor portfolios, right? If you just naturally left the market drift, you got more and more and more overweight the US, more and more underweight international relative to longer term strategic targets. So it's just remarkable to see how these long-term patterns tend to shift. And now we're starting to see these lines come together. I often, illustrate relative performance with a shark chart. You can put shark jaws on this. I believe they're starting to close here as this gap, this relative weight gap in the indexes, the value of these markets narrows over time for many different reasons. It's not just about U.S. companies versus international companies. Even within the same industry, you're seeing huge gaps in valuation. I've talked before about Coke versus Nestle. Again, I don't have a view on the individual stocks, but Coke trades at 6 PE points more than Nestle for essentially companies that sell the same products to the same people in the same markets around the world, beverages and snacks. So that big gap in valuation has to do with the investors and their relative optimism, and that's shifting. And European investors are becoming more optimistic after a decade plus of pessimism, and U.S. investors may be becoming a little bit more pessimistic after decades of really excessive optimism. And so again, these sort of lines beginning to come together. We didn't put a shark on this one, we could have. So these valuations are really important. I think that's part of the reason investors might reallocate money away from the U.S. in their portfolios towards international, even again in those same industries and same product areas where there's just better value for a similar rate of revenue or earnings growth. International stocks are currently valued close to their historical averages. They're not overvalued. If you look at 10 or 20-year averages, look at this chart here. Blue line's the S&P 500 price to earnings ratio. Forward price to earnings ratio, meaning looking at analyst estimates over the next 12 months and taking the current price level and dividing it by that. We're looking at very high valuations for U.S. stocks, almost never been higher, particularly relative to that 20-year average. Look at Europe's stock market. It's right at its 20-year average, right? Or I should say not even Europe. This is international. It's not just Europe. You're looking at EAFE. It includes Japan. It includes lots of countries around the world, developed market countries, right in line. So not expensive at all. So it really does imply greater price appreciation potential for non-U.S. stocks as we think about this going forward. There are a few things that are more predictive over the long term than valuations. They do an amazing job of telling you what your return is going to be over the next 10 years. And when you get excessively high valuations, you tend to get excessively low returns. When you get modest valuations, you tend to get returns that are in line with historical averages, which are around 9, 10, or even 11% for stocks. So seeing a much brighter outlook longer term for international stocks than the U.S. stocks. And look, when we talk about reallocation, this is important too. It's not just about earnings and valuation. It's about money moving. Markets are buyers and sellers. And by our calculations, it wouldn't take much of a shift out of U.S. stocks to make big impact on returns for international stocks. So the impact of these flows, it's like pouring buckets into teacups, right? So if you just move 1% of the value from the market cap of the 10 largest U.S. stocks in the S&P 500, and you subsequently added to the 10 to the 10 largest international stocks in the EFI index, it would increase their market cap by 7.5%. So 1% out means 7.5% in. Just a really big, impactful impact. So I want you to think about this in terms of pouring buckets into teacups, and that's just how impactful that can really be in sort of filling up the valuations of some of those international stocks. So it's not too late to add international stocks to portfolios that remain underweight strategic targets, since these relative performance trends can last for years. And that's probably the biggest message from all of this. Yes, we did forecast strong returns for international in the first half of the year. We got them. We don't think it's over yet. We think there's more to go. Maybe not by the same magnitude we saw in the first half of the year, but we still think international makes sense. Don't think you're too late here. I think we've got years to go. All right. On that note, Michelle and I, we covered a lot of the big picture there. So Heather, let's move to chat Q&A and see what's on the minds of the folks out there in Chatland.
Of course, Jeff. The first question actually is about Japan and looking for an update on the yen carry trade. Are we still concerned?
You know what, Michelle, let me take, I know you've been focused on this lately. I know you're working on a response to some folks who've emailed us some questions on that. So why don't I let you take that one?
Yeah, I think it's maybe helpful to look back a little bit to last year. Bank of Japan started raising rates, their first rate hike in 17 years, in March. But the market volatility due to the unwind of the carry trade didn't happen until the second hike on July 31st. And then when you added in a weaker than expected U.S. jobs report the next day, and the implied reduction in rate differentials between the U.S. yields and Japanese yields, and extreme positioning by speculators who were short yen at the time, that was what caused all that volatility. If we look now, speculators are very long yen. Now we've had a little bit of spikes higher in the longer term yields in the Japanese government bond market, the JGB market. Those have been on the 20-year, 30-year, and 40-year duration yields. And those are more due to low liquidity. There's not a lot of volume in those markets. And also because the Bank of Japan is reducing its holdings of bonds. So they're doing QT. Now remember that Japanese domestic holders own most of the Japanese bond market. So they don't really rely on foreign holders. Now, if volatility returns, the Bank of Japan can reduce QT, or they could even buy bonds again if needed. But it might take more volatility in the market for them to do so, because they don't want to be seen as monetizing fiscal spending. But so far, just using some verbal language, they've been able to calm down the market. And so that's where we are now, but we don't really see this as like a huge global risk.
Yeah, I mean, so if you think back to, August of last year, as you mentioned, July 31st, when they did that second rate hike, what we saw were, the market was positioned on a record-breaking base. We've never seen so many speculators, futures contracts on the CFTC, tracked by the CFTC here in the US, that short the yen. And so all of a sudden they had to go the other way. When you have to cover shorts, you have to sell something else in order to cover that short, because it's basically borrowing, right? When you're short something, you're borrowing it. So you had to sell something else. What do? They sold stocks. They sold anything they could that was liquid. So the market pulled back and they cover those. This is the opposite. They're long the yen now. They're not short, they're long. So you don't, they don't have to cover along, right? You just sell it and there you go. So it's not the same type of potentially disrupting environment. Whenever we see big moves in interest rates, you always worry like, uh-oh, who's holding the bag on that one? But again, as Michelle pointed out, it's the government, Japanese government owns 52% of their own debt. The Bank of Japan. I mean, it's sort of, okay. So there's not necessarily a run there on the private sector when those rates go up and the bond yields fall. But also, speculators aren't positioned in a way that they would have to sell something to cover their losses either. So it's just a different environment. So I don't think we're in that same kind of yen carry trade unwinding kind of situation. I know to some market pundits and some writers out there, they see parallels, but I think it's actually somewhat the opposite scenario than what we saw last August. But thanks for the question.
Thanks so much, Jeff. We do have a question about the dollar. Now, you did touch briefly about how we benefit from a weaker dollar by investing internationally due to the currency issues. How might that also affect other things priced in dollars like oil or commodities?
Yeah, so I mean, it does suggest that if the dollar weakens and gold or oil has some sort of universal value that they would rise. The problem is it's hard to discern some of these trends because one of the reasons why the dollar's weakening is because U.S. relative economic momentum is slowing. That means U.S. consumption of energy is slowing. Which also helps to kind of pull down oil prices, and then we've got OPEC increasing supply. So even in dollar terms, oil's kind of coming down, even though the dollar's going down. So it basically dollar and euros is looking real, starting to really come down and look really cheap. And that's a great news for Europe that pays for a lot of its energy and now has to pay a little bit less. It's one of the reasons why gold has gone up so much, right? As the dollar weakens, gold sort of keeps its store of value, and as a result, it's increased relative to the value of the dollar that it's most commonly denominated in. So that's kind of what happens. But these commodities, which are generally denominated in dollars, largely because of the global financial system that supports it. Really, the supply and demand is kind of pushing those prices around more so than the dollar. But it is worth noting that commodities are global in nature, and so as the dollar goes down, there's maybe some resilience to seeing those prices rise a little bit in dollar terms, even if they fall in euro or yen terms, just because of the relative value of those currencies, the currency. But oil is an interesting one, right? So I'm looking at my screen today. It's up a little bit today on just some of the noise, but it's still $62. It started the year not too far from $62, and the dollar's gone down 10%. So it's really more of the supply and demand in the background pushing things around. Some of that is tied to the same factors that's weakening the dollar, and that's why you see somewhat, oil at least moving in sync with the dollar.
Anything to add, Michelle?
Nope.
No, right. We're a little light on questions today, actually. There are a ton of well wishes for you, Jeff, on your retirement, and it's great to see all of those. There is one last final question, though. What's the plan for the show?
Well, thank you. Thanks, everyone. And yeah, this was our last show, episode 200. And I just want to say thank you. After 30 years in financial services, 25 of them as a chief investment strategist and 10 extraordinary years here at Charles Schwab, I've kind of helped investors navigate bull markets and bear markets and bubbles and baffling policies. And frankly, I realize I've probably spent more time explaining quantitative easing than most people have spent watching Netflix. So for me, it's time. But a key takeaway is that along the way, I've learned that the most valuable asset isn't a stock or a bond, it's trust. It's built over a lifetime, but it's able to be lost in a minute. It's a precious thing. And so to those who I've spoken to or followed my insights over the many years, thank you for allowing me to be part of your financial journey. Thank you for your trust and for your terrific questions, especially the ones that started with, oh, this might be a dumb question, but those are often the smartest ones of all. Your questions have kept me sharp. Your trust has kept me grounded, and your stories remind me of what investing is really about: people and families and futures. And so to my amazing colleagues, Thank you for the debates, the camaraderie, the support, the privilege of doing what I love with people I truly respect. You all made even the most volatile days more stable. I'll be stepping off the field, but I'll be always cheering this team on from the sidelines. I've been working with Michelle Ghibley and Heather O'Leary, who you all know well on this show, for the last 10 years, and they'll continue to guide you on all international developments and their impact on the markets. You can follow them on Schwab.com. You can follow Michelle's LinkedIn account, where she's posting things all the time about her observations on the markets. And I also want to thank our producers, Andrew and Gabe, who've been instrumental not only in making this show happen, but in troubleshooting all my tech problems. And don't worry, international coverage here on Schwab Coaching can still be found. It's going to be found on Trader Talks on Fridays at 9:30 a.m. with Kevin Horner and James Boyd. They discuss the international markets using ETFs in that webcast each week, along with their regular coverage of the U.S. markets. And of course, again, you can all stay up to date on Schwab's thinking on international markets by visiting Schwab.com and checking out our regular articles, and again by following Michelle Ghibley on LinkedIn, where she posts her latest thinking and links to articles. So as I turn the page to a new chapter, one that probably includes a lot more Netflix watching and surfing and guitar playing and all the fun things I like to do, I do so with immense gratitude. I wish you all the best.